right, welcome to part 2 of market manipulation. If you haven't watched part 1, go watch that before this, so this video makes sense. So in this video, I'm gonna go over the anatomy of the M and W formation and other similar formations and patterns you can recognize to help you avoid market manipulation. All right, so this is what an M formation looks like. You're gonna have to get creative. You're gonna have to try to see past all the individual micro movements and try to see it for the bigger picture. We can clearly see an M shape right here. Traders are induced into long positions in this region. So what that means is they see price has been going up. It's a bull market. What do you do in a bull market? You buy. So traders think to themselves, okay, I'm gonna put in a buy here. But then some traders take shorts in this position or in this region because they see that a lower low and a lower high is forming, indicating that a reversal is happening. So now we both have buyers and sellers in the market, both not knowing what they're doing. Those that took shorts get stopped out here. Others may be taking new longs. So what happened there was the people that just took those sells at the bottom of that M, the little middle part, just got closed out. They just lost money. And now price is going back up, enticing people to put in more buy positions or more long positions. But then everyone that took those long positions gets stopped out when price shoots back down to the bottom of the M. Here we have a perfect example of the market makers playing the old switcheroo, trying to get to the emotional side of traders. They trick the buyers way back here. They trick the sellers right here. Then they trick the buyers again right here. And the only real winners were the people that knew what they're doing, like us or the other institutions, banks, all that good stuff. All right, so another formation that's easy to recognize, and it's actually, I find this one really interesting, it's called the wedge. So the wedge is defined as a volume trapping mechanism. A wedge or pennant pattern works in such a way, the same way as a trend line, except that it is trapping volume in both directions. So it's essentially going to create a channel or a squeeze, or basically prices getting very claustrophobic with each other. In the example below, you can observe that on the lower boundary of the wedge, the peaks become slightly higher each time it comes down to the line. This has the effect of ensuring that none of the traders that are taking shorts in these regions can turn profits. Same with the upper region of the wedge. All right, so let's go an example of the wedge. And you might notice that this is the same M that I just showed you. So we can actually see two volume trapping mechanisms that the dealers and brokers, institutions have put into place. All right, so we can see the wedge formation right here. If I need to explain why this is a wedge, I think you should go back to elementary school geometry. But for the rest of you, this is what it looks like. It's pretty easy to visualize. It's going to take some practice to be able to see it in the price movement with the candlesticks. So it's going to take some practicing. Just know that the rule is there needs to be at least 2 hits on the top part of the wedge and 2 hits on the bottom part of the wedge. If you don't know how to draw a trend line, I highly recommend you go back to the video where I go over trend lines, and there's also plenty of resources online about that. So on the bottom right here, that's where shorts are getting trapped. This is where people are putting sell positions because they see a lower low, because they see a bear market forming, they think it's a good time to sell. Then up here is where the longs or the buy position is being trapped because they see a higher high forming. They think it's going to continue as a bull market, so they think it's a good time to put in buys. If there are more longs trapped than shorts, it will ultimately break downwards. So what that means is this is not a guaranteed thing. Very, very few times are there a guarantee in Forex. In fact, if you know of any, please comment down below, send me a message. I would love to know about something that's consistent in Forex. But basically, the way you can kind of predict the way it's going to break out is which had more positions trapped. Because the more positions trapped, whether it's buy or sell, the market makers want to do the opposite so they get more of that money. So we can see here, we see 1, 2, 3, 4 taps and only 2 taps on bottom. So it's a 4-to-2 or 1-to-2 ratio, which indicates that's most likely going to break downward. Now, again, that's not a guarantee. And if you go look at the chart, and I can tell you from experience, it doesn't always play out. You need more than just this confirmation to know which direction it's going to go out to. But this is just one of the easy things to recognize which way it's going up or down. There's no way of predicting which direction price will ultimately break out. This is determined by the net volume that occurs. So if you don't know what net volume is, you can actually go into order books and start seeing what orders are being put in. Unfortunately, I don't think retail traders like you and me have easy access to the exact amount of volume or the net volume. So it's going to be hard to be able to predict it, but that's why we have technical analysis, price action, all these good tools to help us make the prediction, even though we might not have access to what these bigger traders have. And I know there's probably some professional traders out there that do have access to that, but I am someone who learned on my own, someone that learned on Google, someone who just dug through my own research, and hopefully the people watching this can also relate to that, not really having all this information that these bankers and big investors have, and we're just making the best of what we have. And I can tell you, I'm living proof that it works out here in Hawaii. But anyway, going back to the video. All right, so maintaining the validity of highs and lows. As long as the price stays above the low after your entry, below the high, or below the high after your entry, then the entry and therefore the trade remains valid. All right, so that was kind of weirdly worded. So what that basically means is if you put in a buy position, it is valid up until the previous low has been beat. So if you put in a buy and you see price is getting very close to the previous low, but it hasn't crossed it yet, it's still valid. But the moment price goes below that last low, your buy is no longer valid. You're going to want to close out, and hopefully you have a stop loss to do that for you. Same thing with a sell. That sell is valid as long as the previous high does not get beat. So you put in a sell and you see price is rising very, very close to the previous high, but hasn't broke it yet, it's still valid. But the moment price breaks that previous high, your sell is no longer valid. So here's an example. We can see that that low is circled right here. And then I drew a horizontal line so you can see where price broke it. The moment that purple candlestick broke it downwards, that means if you're in a buy position, it's no longer valid. All right. Some caution needs to be applied when interpreting price movement that exceeds the higher low but closes back inside the noted higher low price. A lot of the time, price can just barely break the higher low and snapping back into the range. And that's what it's talking about right here. In these situations, the market makers have spiked price beyond the higher low to both trigger stops as well as to further induce traders to enter the wrong direction. So this might sound contrary to what I just said, but let me show you an example of what this means by that. So we see, let's say we took a sell right at that circle right here. Then I have a horizontal line to represent the previous high. But then we can see that previous high was beat just slightly, but then price proceeded to fall right after that. So there's an example of how even though it broke that previous high, it wasn't the right time to close out the sell or go in for a buy. You have to make sure that both opens and closes above the previous high or previous low. If it opens below it, goes above it, then closes below it again, it didn't count. All right, components of a trading system. The first thing to consider is that you must have a reason for entering the market. A setup in this case will include understanding where the level count is and where your assessment of true trend direction is going to be. So level count, if you're not aware of what it is there are three levels. There's a first consolidation level, the second consolidation level, and the third consolidation level. And typically after the third consolidation level is when a reversal occurs. This can also be recognized with Elliott wave theory. And it's also be recognized by recognizing where price range is or you see consolidation. And then true trend direction basically means what is the big overall trend? Is price going down right now, but overall in a bigger uptrend? Or is price going up right now, but overall in a bigger downtrend? You have to ask yourself, what's the big picture going on and what time frame are you trading on? There must be a signal present for entering or staying out. So if you are a very emotional trader that relies on their intuition, I have some bad news for you. You're going to stay broke. You have to have logical reasoning to join in a trade, not just going off your heart. All right, the signals are a stop hunt, usually in the form of a pin formation or a doji hammer formation to the higher low. So if you see price reaching an extreme higher low and it's starting to form dojis, start looking for a reversal trade. The development of a WRM, just like I showed you previously, if you can recognize one forming in the process, you can actually follow it the whole way through, or more likely follow on up and following it down. Don't really try to trade in the consolidation phase. It's purposely made really, really hard for any money to be made during that wedge phase or that consolidation phase. All right, components of trading system. Once you understand how the market is structured, there are really only 4 trades that you should be looking for, and these have about a 90% win rate. If trades do not present themselves, then the objective of the exercise is to move on and come back tomorrow. It is too tempting when you hop on your laptop, you're ready to do some Forex, you look through all your favorite pairs, and you don't see anything good, then you start forcing trades. Then you start doing bad decisions going, hey, you know, I think I see something that most people don't see. No. You have to understand that you are most people still. You need to be humble, trade like a robot. Don't go without your boundaries. Come back tomorrow. All right, that's it for this video. In the next video, I'm gonna finish out this section of market manipulation. I hope to see you there.